Okay, we are ready to start chapter 20, which is entitled Cost Volume Profit Analysis, CVP. So our very first exercise is number 1, classifying costs. Following is a list of various costs incurred in producing replacement automobile parts. With respect to the production and sale of these parts, classify either as variable, fixed, or mixed. All right, number 1, oil used in a manufacturing equipment. Of course, variable. Plastic, variable. Property taxes, $165,000 per year. So that's a fixed amount. Salary is fixed. Cost of labor, so unhourly, of course, is variable. Packaging, variable. Number 7, factory cleaning costs. It's $6,000 per month, so that's fixed. Metal is variable. Number 9, rent is $10,000 per month plus another $25 per square foot that it's being used. So that's a mix. It's got both the fixed component of 10 and the variable of the 25. So it's a mix. Property insurance, same thing. It's $3,600 per month plus another penny for every dollar over them. So that's mixed. Straight line depreciation is fixed. Hourly wages, variable. Electricity costs. Now, the per kilowatt hour is fixed, but we don't know how many hours we're going to have, so it's variable. Computer chips, variable. And pension costs, variable. All right, number 2, the following cost graphs illustrate various types of cost behavior. Now, you'll see this exact same graphs in the chapter, so hopefully you've read the chapter. But letter A, total direct material costs. Total direct material costs. So as you produce more, it's going to have a line that will go up, so that would be graph 3. Electricity costs, it's a flat amount and then so much per kilowatt hour, that would be graph 4. Per unit cost of straight line depreciation on factory equipment. Per unit. So now we're talking per unit, not just the total depreciation. So as you produce more, it'll go down. Graph 1. Salary. It stays flat no matter how much we do. Graph 2. And a per unit. So now like that, we're saying you're paid $10 an hour. You're paid $10 an hour whether you work 1 hour, 5 hours, 20 hours. We're not talking total, just the per unit. So letter E. Letter E is also graph 2. Number 3, identify the activity base. So for a major university, match each cost in the following table with the activity base. So what drives that cost? Okay, so what drives that cost? All right, number 1. So you got financial aid office salaries, financial aid. So when you got financial aid, what would be the best thing that would drive that? Probably, let's look at letter E, right? Number of financial aid applications will dictate how many people will need in that office. Number 2, office supplies. Well, probably doesn't matter if doesn't really matter on how much enrollment, but how many office supplies are going to probably be needed is letter B, number of students. Instructor salaries, of course, that's going to be driven by credit hours. Letter C, housing personnel. Number 4, letter F, how many are living on campus? 5, employee wages for maintaining student records. Letter D, number of enrolled and alumni. So it's all of them. And number 6, admission salaries. Letter A, the number of enrollment applications. All right. Number 4. Number 4. From the following list of activity bases for an automobile dealership, select the base that would be most appropriate for these costs. So number 1 is preparation costs. Which would be the best activity driver there? Preparation costs, cleaning oil, gasoline costs, probably letter E, number of cars received. Salesperson's commissions, 5% of sales price for each car sold. Letter F, the dollar amount of cars sold. And administrative costs for ordering the cars. Letter C, number of cars ordered. Moving on to number 5, identify fixed and variable. So this Intuit develops and sells software products for the personal financial market, including popular titles such as QuickBooks, TurboTax. Classify each of the following costs and expenses for this company as either variable or fixed. Packaging, variable. Sales commissions, variable. Property taxes, that's usually fixed. Shipping expenses, variable. Straight line depreciation is usually fixed. The salary is usually fixed. Salaries, again, is fixed. Salaries on fixed. Wages is hourly, so that's variable. Cost of providing online support, variable. And then user guides, variable. All right, looking at number 6, child play. Child play manufactures electronic toys with a relevant range of 20 to 150,000 toys per year. Within this range, the following partially completed manufacturing cost schedule has been prepared. All right, so let's look at this. They give you the first little bit there, 40,000, variable 720, total fixed. So total cost is 1.32 million. So a variable cost per unit. So what we do is we take the 720,000 here, divided by the 40, and we'll get 18. Letter B, what's the fixed cost? Well, 15, which is the 600,000 divided by 40 is 15, and the summation is 33. Would it not be fair to say if this is fixed costs here, we just can stick that in there right away? Now, how do we get to the variable costs here for 80,000? So for 80,000, all we have to do is take the 18 times the 80,000 units, and we would get, so for letter J, we would take 18,000. Oh, that's not letter J, it's letter D, I guess. Letter D, $18 times 80,000 is the 1440. So the cost here, variable cost per unit. Let's talk about these two just to make it a little bit more straightforward. So when we're talking about variable cost per unit, we can say it's like hourly pay. So if you're paid, let's say $20 an hour, whether you work 1 hour, 5 hours, 6 hours, 12 hours, whatever, it's still $20 an hour. I'm not talking about overtime. So as you incur more hours, of course, the total will be variable, but the per hour rate is fixed. So you see how it stays 18 all the way across the board, no matter how many you produce. The fixed cost per unit, so the more you produce, the fixed cost in total stays the same, but by unit it goes down because you produced more. So that's the concept for number 6, the concepts that we're covering in number 6. Moving to number 7, high-low method. This company has decided to use a high-low method to estimate the total cost and fixed and variable cost components of the total costs. So here's the data, and if you read your chapter, it detailed how to calculate the high-low method. Units produced, we're going to look at the difference right there, as in the denominator, the difference between 120, the high, and the low of 80. Total cost, again, the high, 32. 120, and the low given there is 25,100. So calculating that, 7 million divided by 40,000 units is 175.50. So knowing that, we can then say that is the variable cost per unit. So let's check it out. 175.50, the variable cost per unit, variable cost per unit. Then how many units are we going to produce? Let's just go with the high. So take it times $120,000 plus fixed costs. That's what we're solving. So we know that our total cost here is 32,120. That's the high, and we're calculating the variable cost plus the fixed cost, and we're solving for the fixed cost. So we now can solve and say fixed cost is 11 million. Well, let's check it out on the lowest value, on the lowest level, 175 now. Let's use the lowest production, 80,000. We're solving for fixed costs, and here it was 25,100. Solving for fixed costs again is 11 million, so we know it works. Letter B, based on Part A, estimate the total cost for 115,000 units. So let's not make this any harder than it is. 115,000 times the variable cost per unit plus what we know is fixed. We can get our total then of 31.2 million. And then number 9, we're starting to calculate contribution margin and contribution margin ratio. So in this case here, Young Company budget sales of 112.9 million, fixed cost of 25 million, variable cost of 66.6 million. What's the contribution margin ratio? What is the contribution margin ratio? So we got to get to the contribution margin. Sales minus variable costs gives us our contribution margin. And then what we do is we take that 46 million and divide it by our total sales, and we get a contribution margin ratio of 41%. If the contribution margin ratio for Martinez is 40%, now sales is 34.8 and fixed costs are 1.5. What's our operating income? Sales, okay, they just said to us is 34.8 million. Sales minus variable costs is contribution margin. Well, we can just drop straight to the contribution margin by taking it times the ratio, 40%. That gets us 13.9. Take away our fixed costs is our operating income. So again, sales minus variable costs is contribution margin, minus fixed costs is our operating income. So in this case, we can skip this because they gave us what the ratio was. Remember, sales is always 100%. We can just go straight to that and then add our fixed costs in there, or take it away for that matter, and we get to our operating income. All right, we'll stop there for a moment to let you review these exercises before we finish the rest of Chapter 20.